Hello, this is Robert Kiyosaki and my sweetheart Kim.
Nice to see you guys.
And this is our annual prediction show, and I don't think there could be a better time for a prediction show given what's happening in the world economy with the U.S., China, Syria, ISIS, ISIL,
Greece,
Donald Trump,
Europe, everything.
Gold, any of this. But the reason it's exciting is also because this book here, which I started writing in 1999, and it's called Rich Dad's Prophecy, why the biggest stock market crash in history is still coming and can prepare and how to prepare yourself and profit from it. And I had trouble with this book because the markets kept crashing as I was writing it. And it says the biggest crash is coming in 2016. And unfortunately, I hope I'm wrong, but unfortunately, it looks like 2016 might be the year we've been waiting for. So to have written this book 14 years ahead of schedule is quite a feat. And now we stand at the edge of what possibly might be the next depression. So our guests today are Chris Martenson, who is in his home in Massachusetts, Russell Gray, who is our friend from the Real Estate Guys, and we always go on the Real Estate Guys cruise, and he's in California, but also Richard Duncan, who is the author of The Dollar Crisis, and he's at his home in Thailand. So a very rich show.
And Chris Martenson, if you don't know already, is the author of the book Crash Course.
Crash Course.
Great book.
He's a very optimistic guy. So unfortunately, all of us are saying kind of the same thing. And so I'm glad you're paying attention. And this show is especially important for those of you who I would call passive investors, Kool-Aid drinkers, who bought the idea of invest for the long term in a well-diversified portfolio of stocks, bonds, mutual funds, ETFs, and funds of funds. Because when the market crashes, you're the guys who get wiped out the most. So please pay attention. This is predictions from the Rich Dad Company.
And a lot of these people, a lot of you who are watching are actively investing and actively in real estate and business and things like that. And we're also going to go the other side, which is, when this thing crashes, there is going to be a lot of opportunity. So
yeah, it's a good
those
time.
of you who are getting educated and are actively involved in business and investing, there's going to be a lot of opportunities. So we're going to talk about that too.
Right. And Kim and I just came back from China 2 days ago, more specifically Hong Kong and Macau, and it's really interesting to see what's going on in China. And again, we're not the China bashers and all this, because I personally believe this is a global crisis. I think it does start with the currency, which in 1971, President Nixon took the dollar off the gold standard, and today we're no longer a gold standard world, we're a dollar standard, and the dollar is corrupt. So the U.S. dollar is primarily causing much of this fluctuation throughout the world. And what you're going to see is I have a chart up here. It's a picture of the Dow from 1895 to today in 2015. And you notice it is an all-time high. Now, there's many people believe the U.S. economy is very, very strong, and the Dow will now go to 2,200. I don't think so. And I'm afraid we might be going, look at this chart here in 2015. It's a long way down. There's one more thing I'd like to have you look at on this chart here, give it a perspective, is 1929. And you look at 1929, that was the giant crash that caused the Great Depression. And the giant crash of 1929 was but a blip. It really didn't make much difference. So but I want you to look at this chart of where we were in 1929 and where we are today in 2015, and you may understand why I wrote Rich Dad's Prophecy. If I'm correct and this baby comes down, there'll be millions of people who will be wiped out. We may not go into a global depression, but millions of people who have money today may be personally depressed. So that's why this predictions video is important for all of you to pay attention to. We're not saying we're right. We don't necessarily give advice or recommendations. We think we should pay attention because this is a critical time, not only in the world's economy, but world history. Anything you want to say?
Well, I think it's interesting that we just got back from China and Hong Kong, because a lot of the news that is going on over here about how great China is and how it's, booming and all of this. It's not, and they know it, and they're reporting it, that they know that their exports are slowing, that the world is not consuming their goods as much and quite a bit less. They're looking at ways to prop up their own economy domestically.
They're playing games.
And they're playing games. And they're playing games with their stock market too, because you can see that. But it's interesting to be at the place at this time when the markets are so volatile right
I'll
now.
give you an example. Is that it's now a crime to sell stocks because they don't want the market to crash, and so you're a criminal if you try and short or get out of the market.
It's illegal to do certain things now in the markets. It's illegal to sell some of your stocks. There's a lot of new rules that changed overnight, just like that. Kind of like the U.S., kind of like the world.
So I think it's not just China or the U.S. I think the world is in trouble, including Europe, and especially with this guy Putin and America now getting ready to go to war in Syria. So we're in a very exciting time. So our first person we'll ask to talk to us is Chris Martenson. He's been a great friend. We've traveled through South America together giving talks, and that was exciting. But also he is the author of the book, The Crash Course. When I read his book, it really opened my eyes. I mean, my eyes are open, but they got wider. So the thing I love about Chris, he is actually a scholar, worked for a Fortune 500 company, but when his own portfolio took a hit in 2000, it kind of woke up from the idea of invest for the long term in a well-diversified portfolio. And that's when Chris became, like Kim and I, a student of what's really going on in the economy. And so I highly recommend you read his book, The Crash Course. So welcome to today's show, Chris.
Robert, Kim, it's a real pleasure to be with you today.
Oh, great to have you here, Chris. Thanks. Hey, what's your website, Chris?
That's peakprosperity.com.
Peakprosperity.com. I'd highly recommend it.
So has your view changed for 2016? I mean, what's your predictions for the coming year?
Well, my prediction, for a couple of years, I've been on pins and needles like a lot of people, particularly people who really know the financial system. Like when I talk to hedge fund managers or people who are deep in the banking system, they share my concern that these markets are broken, they're fraudulent, they're pumped up, and everybody's sort of waiting for the other shoe to drop, by which we mean some sort of big correction. And so the longer this goes on without that big correction, I just think the worse it actually gets. It's kind of like if we're going up a ladder, you'd much rather fall off from the 5-foot level than the 45-foot level. And so I'm concerned because I think that everything the central banks have done, this includes the United States Federal Reserve, the Bank of England, ECB, the European Central Bank, Bank of Japan, they've all been, Robert and Kim, what they've been trying to do is sustain the unsustainable. They just want asset prices to go up because they think if they could just have the stock market high for a while and bond prices really elevated, that somehow the world would recover. Well, it hasn't. So I'm looking forward to the next year or two, but probably within the next year as being the most likely time for a great unwinding to really happen. And it could be Brazil defaulting on its bonds. Venezuela is almost certainly going to default. I hope people are out of the way of that one, but it could be Greece, or it could be a big company like Glencore, the world's largest commodity trading firm, is in the business of looking like it's going bankrupt. Who knows? There's some pin out there that these bubbles are waiting to find, and it's going to be something, and we'll look back and say, oh, it was Glencore, or oh, it was Greece. But it'll be something. And so that's my view, is that we're in highly risky territory and that something's going to break in the next year.
So would you briefly explain to the group what's your background? You're a PhD, you're a very highly educated person, but what was your wake-up call when the crash around, I think it was 2000, the NASDAQ crash? Yeah,
like everybody, I like most people, I was investing for the long term. I had a nice stock portfolio. I was busy working away. I was vice president of a large company. I'm a saver at that point in time, so I'm really saving a lot of my money. And then, of course, 2001 happened. I actually owned some WorldCom and other fraudulent companies like that. And so when I started asking my broker questions, he was giving me answers that were frankly really unsatisfying, saying, oh, stocks for the long haul, stocks go up 10% per year if you're patient, you don't want to make a mistake by selling at the bottom. So I just rode my portfolio to 45% losses, right? So that's a couple of decades of savings for me. All of a sudden it's just gone. and I wanted to know why. So I got curious, and I started discovering things like that from that peak of the stock market in 1929, you didn't get back to break even just in dollar terms until 1954. It was 25 years before you just got back to even if you had bought at the peak of 29. And so I don't know what my broker was thinking stocks for the long haul. It looked clear to me that there are times when you want to be on the long side of this story and other times you clearly want to be on the short side. My wake-up call was discovering that most of the financial industry only cared about having me be fully invested at all times. That's their job. Now I understand it. I see their motivation. I see that their motivation and mine sometimes are at cross purposes. So that's really where I started to wake up, is when my savings got shredded and I finally understood how the system is actually set up.
So also, doesn't it make you sick to hear people saying the same stuff your broker was telling
just
you
thinking about
in
that.
2000?
Yeah, and we had that little 10% correction a month and a half ago, and the Wall Street Journal, New York Times were all saying, oh, only nervous people are selling out. You don't want to be one of those, trying to make it sound like you were somehow a less than equal person if you wanted to take some of your money off the table and keep it safe. Like there's something wrong with not being part of a system that hasn't had a 10% correction in over 1,000 days, one of the longest runs in stock market history, that somehow you were nervous Nelly, So really there's a whole system there that's designed. It's got great marketing copy. They think they've got great psychologists on the job, and they're there to convince the little people, that's me, to stay fully invested. And so now I can see what they do. And actually it looks like cheap tricks. Like once you figure out how the clown does his trick, you're like, that's just a cheap trick now, right?
Well, yeah, but the thing I loved about your book, Crash Course, was, how you say how fast the change can come or the crash can come. The reason I say that, when I talk to people about, like we just did an interview on Rich Dad Radio with Dr. Alexander Elder, most people aren't going to take action. Do you know what I mean? I can talk about how I do my real estate and how I do this, but most people don't change. They don't take action. They believe they have time left. I'm still young. I don't have to worry. My job is safe. My portfolio is safe. You guys are fear mongers and all this. But not only did your book Crash Course bring up with the data of what is wrong, but you have this terrifying metaphor of how fast this economy will change. And that metaphor was, if you're sitting in a football stadium or baseball stadium, what happens if you add one drop of water? So would you mind giving us that metaphor? Because most people, when I talk to them, I can hear their mind going off. I don't have to worry. That's not going to happen to me. And they don't do anything today. So the most powerful thing, not only the data that you researched, but how fast it's going to come and hit us.
Absolutely. So what we're describing here is when I go and I talk to audiences and I ask people, put your hand up, who feels like the world is going faster and faster? And everybody puts their hand up. So we all know the world's going faster, but many people don't understand why. And the reason why is because we're surrounded by this type of growth. It's exponential growth. Things are going really just exponentially faster all the time. Sometimes good, sometimes not good, right? It's great that our technology is getting exponentially better, but it's not good that we're losing species at an exponentially faster pace. And so people don't understand what that means, though, exponential. What does that mean? So I describe it like this. Imagine that you have a magic eyedropper, and it's magic because when you take a drop of water out and you put it in your hand, every minute that drop of water will double. So you put a drop down, and after 1 minute, you have 2 drops. And after 2 minutes, you have 4 drops. And after about 5 minutes, you can fill a thimble up with this magic water. And so the thought experiment to help people understand this goes like this. I'll ask somebody watching this, imagine you're at a stadium, the biggest stadium you've ever been in. And imagine that you are handcuffed to the highest row of bleacher seats in that stadium, and it's watertight. And I go down into the middle of the stadium at 12 o'clock tomorrow, and I put this magic drop of water down. You're handcuffed to this bleacher seat. And the question is, how long do you have to escape? And the answer is you have 50 minutes. So at 12:50, this stadium is completely full. And even if your stadium is twice as big as the biggest one I've ever measured, the answer for you is, when is your stadium 100% full? Is 12:51, right? It's doubling every minute. So That's not the important question, though, in this story. The important question is, when was this stadium still 97% empty space? And how many of you realize the seriousness of your predicament? And the answer is, at 12:45, this is still 97% empty space. Just a little bit of water in the infield or across the 50-yard line, just some water. But then 5 minutes later, it's all over. And this is relevant because our money system is growing exponentially. Our debt system is growing exponentially. Our use of water is growing exponentially. Our use of energy, all of these things are growing exponentially. And so the point you're raising here, Robert, is really important, which is that when the crash finally comes, we're going to have all these exponential curves coming together, and they're going to go a lot faster than most people realize. Because most people will be up there eating their hot dog in that bleacher seat, and at 12:45 they see a little water and they're not concerned. They don't know that they only have 5 more minutes to get out of their seat, right? That's the world we live in. It's not your grandfather's world. Things are moving very, very rapidly, sometimes for good, but sometimes for bad. And that's the part I think most people are psychologically unable to think about, don't want to face it, don't want to talk about it, is the idea that there are a lot of things happening that are not positive, that represent risks, that you could, I think, if you were being a prudent adult, you would say, I should do something about that. Like I carry fire insurance on my house because those too progress kind of quickly when they start and they're catastrophic. So there's lots of things I think people can do to create insurance in their lives, as it were, that really makes a lot of sense. The least strategic thing somebody can do is to cross their fingers, close their eyes, and hope that their portfolio is going to do well over the next 5 to 10 years.
So Chris, there's some warnings that are happening now, some things that are happening. So that's like this little bit of water in the bottom of the stadium. But you're saying something's going to put it over the edge, and it's going to happen that quickly.
Absolutely.
So what are some of the? You said there's some things that people could do today. What would you recommend? Based on your predictions, what people could do today?
Well, my business partner, Adam Taggart, and I have a second book coming out in just a few weeks, and it's called Prosper. And it starts with this idea that our financial wealth is a cornerstone of our wealth. And we think that wealth should be carefully managed. You should have it managed by somebody who understands the risks if you don't understand them yourself, all of that. But that's just a piece of your wealth structure. That there are other forms of wealth that we need to be aware of and that we need to build up, because there's nobody so poor as somebody who only has money, right? If that's all you have, if you don't have rich social connections, you're just not going to fare all that well. You know, I was in your offices in Phoenix, and you were interviewing Philip Haslam, and he wrote this great book about money and Zimbabwe. And he described people who stored up a bunch of material possessions because they saw that their Zimbabwe currency was about to fall apart. And so they stored petrol and food. And they did pretty well for about a year until their material stuff ran out. And then, the crisis lasted many more years after that. So who did best in Zimbabwe? It turned out the people who had rich social connections, who knew how to find what they needed and knew how to navigate and had favors owed and knew how to work in that social system to get what they needed. They did much better than people who didn't have social connections. So we believe people should be building up their social capital at the same time they're building their financial capital. I build up a lot of living capital in another form, which includes my garden outside, which I put compost on, and I buy amendments, and I have rich soil, because I think being able to grow my own food could be important at some point in the future. But my living capital is my body, so working in my health as well. I think somebody who has a decent amount of money, has great social connections, and is rich in living capital is going to do a lot better than somebody who just has financial capital. And so as we go around, we have 8 complete forms of capital that we identify and talk about, and there's ways to build up every single one of them, with one exception. I don't know how cultural capital is a very important one, but I don't know how you create that really. So cultural capital is the difference between when the earthquake and tsunami hit in March of 2011 in Japan. Their culture responded to that. No looting, no rapes, no reports of police going violent on their citizens. Everybody was helping. They have a culture that has a way of dealing with crisis like that. And you contrast that with what happened in New Orleans in 2005 with Katrina. Totally different cultural capital model there. People were dependent. They didn't know what to do. They went to the Superdome. There was rapes, looting, violence, killings. It was awful. And so that's an example of where your cultural capital, I think, is something you either have or you don't. But accepting that one, all the other forms of capital you can build, and the most important one we've identified, the most important one is actually your emotional capital. That's your mental ability and toughness to see the opportunity that are going to be coming. Those people who feel like their job went away, their paycheck went away, their portfolio went away, they're going to be devastated by that. They won't have the mental toughness. Many of them will check out. They'll drink too much. They'll play too many video games. They won't get engaged in life. Some of them will kill themselves. I mean, it's just what people do in crises. Whereas instead, what's really about to happen is that we're about to enter the period, it's going to be one of the greatest periods of wealth transfer, not destruction, but transfer in all of history. And that's because the real wealth won't go anywhere. Your 401k might get vaporized, but the real wealth, the primary wealth, the rich soils, the good waters, the ore stocks, the oil wells, and the secondary wealth, the means of production, highly, good cash flowing businesses that are delivering real things that people need, those won't go anywhere. They'll still be there, but who owns them is going to change hands big time in this next financial crisis, is the view we hold at Peak Prosperity.
What do you mean, who owns that will change? If you have a good cash flowing business, why would that change?
Well, it'll change for the people who have too much debt on that. It's going to change for the people who don't own the equity in that business. It's going to change for the people who otherwise haven't really taken the steps to make sure it's entirely theirs, right? So somebody might say, "Oh no, I own a piece of a company. I own 1 million shares in this great company." Well, maybe you own something, maybe you don't. It depends on how this goes. So we saw this happen in Weimar Germany, right? So from 1918 to 1923. They printed physical money, and it was one of the most explosive periods of inflation ever seen. Books are written about it, and they still say this was a period of extraordinary wealth destruction. The middle class, it's true, was completely wiped out. They had government programs encouraging people to buy government bonds and hold on to them, and these people just got wiped out. But when you take a snapshot in 1918 and 1923 and you say, where was the real wealth of this country? The hotels were all still there. The fields were all still there. The property, plant, and equipment of all the factories was still there. The real wealth was still there. But who owned it? Boy, that changed. That changed completely. And we saw a little taste of that here in the United States. From 2006 to after the housing bubble was burst, who ended up owning the mortgages on the houses in this country? Well, it's mostly the Federal Reserve is now the largest single mortgage holder in the country, right? How is it possible that the Federal Reserve now owns more real estate than any other single entity on the planet? Well, if you understand the rules of the game and how the Federal Reserve is constructed, it makes all the sense in the world. They print money out of thin air and they buy stuff with it, including mortgage-backed securities, which are the claims on mortgages. So this is just understanding how the game is played is really important, and play it in the system all you want. Our advice is to also have wealth outside of the system, because that's the wealth that's going to be your insurance. It'll stand, it'll survive if the financial system has a big accident.
So what's wealth outside of the system look like to you?
Well, for me, it looks like it's gold, physical silver I have outside of the system. It looks like right now it's actually the physical cash that I'm storing, because I think there's better prices coming after the accident happens. It looks like the land that I own. It looks like all of those tangible things, plus any tangible cash flowing business that's providing a real service to people, or particularly ones where you can have good access to the primary materials of that, so your supply chain is solid. Those are going to be people are always going to have an economy. Look, if the dollar completely goes up in flames, or the renminbi or the yen, any currency, even if it totally just burns in the international stage, those countries will still have an economy. People will still be trading and accumulating wealth and exchanging wealth. It might not be in dollars or yen or renminbi, but there will always be an economy. So I advise people to really look for, how do you add value? What do people always value? What will they always need? And whether we're using dollars or some other tokens, it doesn't matter. You want to own the means of production as much as possible, at least in part. And so those are the kinds of things that I own currently.
So the final thought for you is this. You have Syria and United States and Russia and the world kind of meeting over there. But also you have events like Ferguson, Missouri, where you have civil unrest. and you talk about having a garden and all this wealth. Do you also own a gun?
Oh, yes, many.
So you plan on defending yourself.
Of course.
So you're not counting on. And we talk about how the culture is the American culture one of peace and happiness and cooperative like the Japanese, or are they going to come and steal and take everything you got?
Well, I say that local mileage is going to vary. There's certain places in this country I wouldn't live, and a lot of them are major urban cities with a high degree of people who are in a very dependent sort of a state. Those aren't places I want to be. I happen to have moved specifically to a semi-rural location where I judge that the people around here are fairly self-sufficient. Obviously, they'll have some learnings if things get tighter or crash in any way, but I think that you can find pockets around where there'll be much better results than other places that we could talk about.
And that would go for throughout the world.
Absolutely.
So, final question is this: what's your view on the Europe as big picture economy?
The big picture economy in Europe?
Yeah.
Yeah. Well, Europe's really been lagging for a while, and this whole refugee crisis that's coming in is probably there's a good chance it's going to take the European experiment apart. So the European Union relies on a number of things. One is free travel across borders, just like it's the United States, and also they have a lot of agreements. And one of those is that they're going to settle these refugees. And there's a lot of refugees, Syrians, but also migrants, not refugees, but economic migrants from the North Africa side of things, all sort of streaming into Europe at this point in time. And there are countries there which are saying, no, we don't really want a big influx of people who have a different culture in our culture. At this point in time is creating a lot of tension. But I think Europe's got to do a little soul searching on this one, because Europe, through NATO, was responsible for arming and bombing and otherwise creating unrest in these countries, which they now are getting refugees from. I think it's a little like the Pier 1 philosophy, or Pottery Barn, I guess it was. You break it, you buy it. So they're really struggling with their sense that these refugees that are coming in from Syria were created. And it's not without, it's really important to understand that Syria didn't just erupt into a civil war. And when you look at pictures of who these so-called rebels are, unless you don't know how to read the genetic makeup of people, you can clearly see that these aren't all Syrians fighting the Syrian government. There's Chechens in there, there's Somalis in there, there's Pakistanis, there's all these different Muslim fighters from all over the world have been attracted because guess what? They're well funded, and various Western countries have been funneling arms to them, and so has Saudi Arabia. So the whole thing, this idea that Russia's over there stirring something up, is absolutely untrue. Russia's trying to put out a fire that's right on its border. And they're trying to put out a fire that NATO created, and with the help of Saudi Arabia. And so the whole place over there is not even remotely, like if you read the newspapers and that's all you read, you probably have no actual idea what's going on over there. You have to have some alternative context. The United States has been just stirring up the whole region and has had we've created disasters. Libya, Egypt, now Syria, Iraq, obviously. You look at all of these cases, it's clear that the United States has a sort of a stirred up sort of a policy, and that's going to backfire at some point. I have a lot of concern that there was a report, as yet unconfirmed, that a Soviet fighter was shot down somewhere near the Turkey or over the Turkey border. But, NATO condemned the overflights of these Russian jets, saying that's a violation of airspace. Meanwhile, we just did, air flights into Syria last night and yesterday and the day before. So it's just a mess over there. And the fact that you have Russia and NATO in such close proximity, my concern, what keeps me up a little bit at night, is that there is a chance when you have that much military hardware and active firefights for an accident to happen, for somebody to shoot somebody down who shouldn't be, and that could escalate. So it's very, very tense situation. And I think my read of it is that Russia is tired. The whole Ukrainian situation, stretching back a couple of years, really taught Russia that they were really, that the West was going to do everything possible to marginalize Russia and push them out. And I personally think that's a big mistake, because Russia was being very agreeable and wanting to be drawn closer. And they're very powerful, despite what some people think.
And what's your view on the Asia region?
Well, China's, the big story over there, obviously, and I think you have some firsthand accounts of things I've been tracking, looking at the import-export data in particular, looking at electricity consumption actually declining. My personal read is that China is not just growing slower than 7%. I think they're growing below 0%. That is, I think they're shrinking. And of course they had to, right? 50% of their economy was based on building houses and apartment buildings. And it was basically a construction-led GDP boom. And if those always come to an end, and they didn't have a transition policy, once that was over, how do you replace 50% of a GDP as large as China's with import, export, or even trying to goose domestic demand? Hard to do. I think impossible to do. So I think China's already over the edge. Many, many bad loans there are going to come due. The wild card is it's a command and control economy, and of course they can will things. The state can will things that other countries can't do. So they might go the route of Japan and just have bad loans forever. But I think the growth story is over. We're seeing that in commodity prices, and I think it's going to go even further than that. So I think China leads the way on this one, and by leading I mean leading the world into a recession. And that's going to be very, very troublesome for the central banks and the huge piles of debt we have in the world system right now.
Yeah.
The U.S. economy.
The U.S. is going to follow all of that. I've not been a big believer that our economy is as strong as advertised. Once you look at our statistics and, you just scratch at them a little, you discover some things that they're really put together. Fuzzy numbers is how I put it delicately in my book and video series, but they're really fraudulent on some levels, right? And so our economy is not as strong as advertised, but of course you would know that if you looked at anything like the amount of student and auto loans that are out there, you looked at the number of people on food stamps, or you looked at real median wages declining, that the recovery that we've had so far has been led by mostly recoveries and earnings per shares by big companies who have used low interest cost money to buy back their shares, and a massive, massive flow of wealth from the Fed to the very wealthy, leaving out most everybody else, not even the 99%, but I think the 99.8% or whatever. Like most people got left behind in that story. So congratulations, the central bank propped up asset prices, but they didn't fix the underlying issues and we didn't address them. And so I think we still have to pay that bill.
And just going back to China for a minute, because we just interviewed Dr. Alexander Elder. He's a professional trader. He said that when the China stock market basically blew up, and that he predicts that it kind of happens every 4 or 5 years in China, and that in the next 4 or 5 years, he doesn't think we're going to hear much from China because their economy is going down so much. What do you think about that?
Are you suggesting that he's saying that China will just sort of cover it up and we won't hear much and they'll just put a lid on it?
That's kind of what it sounded like. It's not going to be this big world thing of this is where the new age is going. It's just going to kind of be low key at this point.
It could be, but I'll tell you who is going to feel it. It's going to be Australia. It's going to be Canada. It's going to be those countries that are exporting. Yep, Brazil. And so, my advice to people in Australia, massive property bubble they've had down there. And it was all really based on this export model that everybody thought was permanent. That's not going to be true. So to the extent that, all their iron ore, coal exports, the basic materials, I think Australia is in for a rough ride on this. So China could go quiet, but their trading partners are going to feel it.
So what you're saying in Crash Course, it's still coming, the water's rising, and people still think the U.S. is strong and the world is strong. So anyway, I want to thank you for that and thank you for your input, and we'll move on. But once again, how can people get in touch with you? It's Peak Prosperity, right?
PeakProsperity.com, great website, a lot of tools there for people who want to get ready and prepared for what's coming next.
Right. And your new book, you and Adam are writing a new book called what?
Prosper with an exclamation point. And
when does that come out?
That comes out early November.
Perfect.
Okay.
Perfect.
So again, thank you.
Thanks, Chris.
Thanks. My pleasure.
See you on the block.
Thanks for participating in the live stream today. We are interrupting the stream for a brief moment to make a special announcement. In honor of Robert's mission to elevate the financial well-being of humanity, we're offering everyone participating in today's event a free strategy session and the opportunity to receive 6 months of free access to Robert's coaching team when you enroll in any new coaching program. This free strategy session will show you how to personally take advantage of the opportunities Robert has identified for 2016. So use this time to take control of your financial future by clicking on one of the banners below for this exclusive offer. Now let's get back to Robert and his team to hear more about 2016.
So now I want to thank Chris Martenson one more time. And once again, his book is The Crash Course. And our next dear friend for years and years and years, nearly 20 years now, is Russell Gray. He has a fantastic radio program. They're known as the Real Estate Guys, and they are for real, which is rare in the investment business, because most guys who are talking about investments aren't investors. But Russell and his team, the Real Estate Guys, put on fantastic programs. They have a thing called the Real Estate Guys at Sea, and Kim and I and our Rich Dad team often goes on cruises with Russell. And he's coming to us now from Anaheim or someplace in California. I don't know where you live anymore, but he's moving around like most people are. And we're going to talk about real estate and how that looks for the future and our predictions. And as you know, we love real estate, right?
We do, and it's funny you say that most people who talk about investments aren't really investing. It's pretty funny, but it's really true.
So can you give us a brief overview of how you and Robert Helms teach people about the intricacies of real estate?
I think, our motto at the Real Estate Guys radio show is education for effective action. So we want to teach people things that are actionable. And we kind of start with a lot of the mistakes that we've made and we've seen people make. And most people do it backwards. They start out buying the property because they know a guy or they happen to live in an area and it maybe looks like a good deal. And then they try to figure out how to have a team to help them. They look for a property manager and maybe an accountant who understands it and, people that can help them. And then one day they begin to understand the market that they've invested in, which may or may not be a good market for whatever their investment objectives are. And then after a lot of pain, they begin to realize, hey, I don't really like this kind of investment. I thought it was going to be more liquid, or I thought it would be more cash flow or whatever.
Well, they thought it was going to be easy.
Yeah, so we turn it around. We say start at the top with your personal investment philosophy and strategy. What are you trying to accomplish? What do you want your real estate investing to do for you? And then look for real estate markets because they're different. They behave differently. And when you understand what a market is, it's like the big fish bowl that the property is in, and it'll float up and down in that particular market based on what we call drivers. And we like markets with lots of drivers and not just one. A lot of people got all excited about North Dakota because it had the big oil boom, and it was just a single story. It was just a one-trick pony. And we'd like, it's just, if anything were to happen to oil, and we're big believers in oil, right? But look what happened. And so people who went up there and kind of bet on that ended up on the wrong end of the stick. So we like diverse markets. And then once you get the market, then you drill down and you begin to build relationships in that market with people who can actually help you find the properties. Because the big disconnect for a lot of investors is when they want to invest, how do you find the deal? You can't just get your smartphone and get a stock trading app and sit there in your crib with your diaper on and order up real estate. It doesn't work that way. So you have to have relationships at the street level.
So given the economy ahead, what are your predictions for real estate? And are you still investing, or you tend to cut back, or what are you doing?
Yeah, so we focused on international real estate. That was a strategic decision we made to follow a demographic trend, and our desire was to try to find a way to earn rents from affluent. You've been teaching people for years that the rich are going to get richer, and the poor is going to get bigger and poorer, and the middle class is going to get wiped out. And clearly, that's what we've been seeing happen.
So offhand, do you know of some international sites that are ideal for people moving? For example, for Chinese who have lots of cash, Hawaii is fantastic. To buy a condo right now in Waikiki, the down payment is $600,000. That's the down payment. That's not the price. So most our friends in Hawaii go, oh, that is so much money. So the Chinese are running out of Hong Kong and China and buying in Hawaii because they want to come onshore to the U.S. They're also buying in Australia and other parts of the world that are friendly to Asians. But what other places are people running to?
Well, it's interesting because I think people are just trying to diversify. Americans are looking to go outside the United States, but ironically, a lot of foreigners are actually coming into the United States. They look at our respect for private property and rule of law. I mean, if you're coming from a communist totalitarian country like China, and you look at the U.S., even though from our perspective we say we're not as free as we used to be, we're still a heck of a lot more free than they are. They prefer, markets like San Francisco have been very affected by the influx of Chinese money. And ironically, I think Dallas was like the number three market for Chinese. Like 11% of the properties sold there were being bought by foreigners.
So where are people in the U.S. going to? Where are they moving to outside the U.S.?
I don't really follow that as much because I'm more interested in where people are coming into. Obviously we pay attention to Belize. Mexico is the largest expat community. It's south of the border. It's got most of the major amenities, and it's still relatively friendly to the United States. I mean, in spite of a lot of the horror stories, people who live there seem to like it. There's other Latin American countries are pretty friendly. A lot of people go to Panama. Costa Rica has really good medical. That's a big concern. People who are in their baby boomer years and they're going someplace to retire have to have access to good quality medical care. And so Latin America is probably one of the most popular destinations for U.S. expats because they have good proximity to the United States, and yet they have access to most of the major services that they need. The pricing makes sense. The cost of living is more affordable than the United States.
And right now you're also looking at farmland, is that correct?
Yeah, this goes back to this notion that the world, I think, is on a collision course with a major financial disruption. The macro picture on that, and I follow Chris Martenson as well, and he talks a lot about these kind of things. Simon Black talks a lot about these kind of things, and to me, the macro picture is really what the train wreck is, and it's pretty simple. You have 30 years of falling wages, you have 30 years of falling interest rates, and 30 years of rising debt. And it's pretty simple to figure out that what we've been doing is refinancing a growing pile of debt to a lower interest rate to leverage a shrinking income to debt service. But we're at the bottom of the barrel. Interest rates are at zero, and people are still strapped. You still can't get, we've got housing, home ownership at nearly a 50-year low. So it's the lowest rate it's been since 1967. And yet we have interest rates for 30-year mortgages that are like 3.75%. People can't afford to buy houses. And so it's really not conceivable that we're going to be able to continue to grow our debt in order to expand our economy. And of course, our whole financial system is based on ever-increasing piles of debt, and we just don't have the productivity to support it. So there's going to be a train wreck. When that train wreck happens, everybody is going to forsake all of the splurges, all of the non-essential things, and they're going to focus on essential things, things that are real, not paper, things that are real, and things that are essential. And when you think about what's real and essential, housing, real, essential. Food, real and essential. And the thing that I love about food is it combines a land play, a real estate play, with a business play where you derive income from producing a commodity. So again, it's a commodity play. And the beautiful part of it is that whether the people live in the United States, Latin America, or China, wherever the populations are growing, food can be exported. And when you go to buy a rental property, you kind of got to get the local economy right. If jobs leave or you miss something, you can end up in a declining area. I just feel like it's a little bit safer. It's more complicated. It's one more thing to learn. But my experience has been that most people who get intimidated about learning how to do real estate are probably doing something for a profession that is a whole lot more complicated than being a real estate investor. I think a lot of people make it more mysterious than it really needs to be. It's largely common sense. As I started off in the top of my comments, just people go around it backwards. Because they do it backwards, they end up in problems, and real estate gets a bad reputation, when if it's done properly, it's not quite that bad.
You said something else at the start of this program. If you don't mind, I'll ask the question. You had some friends or family member move out of Silicon Valley and into Arizona. And you said part of that reason is because, and this is a huge problem, the rich are so rich. And if you're middle class, you're really lower class. And so some of that pressure is socioeconomic. You know what I mean? If you're going to school with kids whose parents are making $4 or $5 million a year and you're making $50,000 a year, that's pressure also. It's you know what I mean? The rich versus the middle class.
Absolutely. I mean, and people, young people, young families are having to make those decisions every day. And if you just look at the migration patterns out of places like California and into places like Texas, a high tax state to a low tax state, an expensive housing market to an inexpensive housing market, a market that is not, well, they've been creating jobs, and they've been creating great jobs in Silicon Valley, but they're for people who have a certain degree of skills, and it's a very narrow set of skills, and a lot of those people are actually coming in from outside the country. And so if you don't fit into that demographic, you're right, Robert, you're a second-class citizen. And at some point, a parent has to look at that and go, I'm working hard, and maybe working 2 jobs, or maybe mom and dad are both working 2 jobs, and I barely have time to see my children, and they don't have, a nice house, they don't have a nice car, they don't get to do nice activities, and I'm working this hard. At some point, people realize something's got to give, and they start looking for alternatives, and they reach out to friends. In this particular case, this couple that I'm referring to had friends here had friends in Arizona, and they said, hey, can we come visit with you and see what it's like out there? And they came out and saw these people making similar money, but living in a big house and having a nice car and having time with their children. And I'm like, oh my gosh, well, I think I'd rather do this. I can give up a little bit of that California weather, and I'll suffer through a little bit of the desert heat in order to give my family an opportunity for a better future. And I think people are making those decisions all across the spectrum, not just young families. Retirees are making those decisions too.
Yeah, so that's one of the reasons, like I had friends who moved to Detroit to buy it because it was cheap. And what I said to them, I said, you better look at the long-term demographic trend. Is the people with money are moving out, and the people who are moving out, a lot of them have pensions, and that pension money was created in Chicago, Detroit area, but that money is no longer there, which accelerates the decline of major cities.
Yes.
And so when you're looking at trends and migrations, just because someplace is cheap doesn't mean it's a bargain, does it?
Well, that's the whole point. When people start out at the property level because they can get quote unquote a good deal, and then they figure out the rest of it after they're an owner, that's where people mess up. That's where they end up buying a disaster. And they don't know it's a disaster until they find out the hard way. Better to start from the top down, because there's a lifestyle that you have, when you're an investor, and you have to interact with, a demographic, and you have to interact with people who are going to be your service providers. And you have to decide in your personal investment philosophy, how do I want to spend my time? My partner, Robert Helms, for a long time was a C-class apartment investor. These are rough neighborhoods, and the cash flows can be good if you really know how to operate that type of property, but it's a tough demographic to work with. And if you don't know what you're doing, you can lose a lot of money. But after a long time of doing that, he woke up one day and goes, I really don't like this. So how can I arrange my investments in such a way that it enhances the way I want to live? I get to go where I want to go. I get to spend time with people I want. And that was a big part of our move in going to Belize. So today, we're very involved in a very nice area, and he doesn't go to Belize to check on the properties, kicking and screaming. He looks forward to it, and so that's where your personal investment philosophy helps.
So once again, how can people get in touch with you guys, the real estate guys?
Well, I think the easiest thing to get to know us is listen to our podcast, which is easy to find. You can visit our website at realestateguysradio.com. And we do a newsletter once a week announcing our latest podcast and making a comment on something going on in the news to help real estate investors stay awake and understand what's going on. And you can get on that list simply by sending an email to newsletter@realestateguysradio.com. And then we can get to know each other.
Right. And then the real estate cruise, where is it going this year?
Yeah, the Summit at Sea, we're going to start out of Miami, Florida, and we're going to go to Cozumel, Mexico, Grand Cayman, and we're going to go to Jamaica and the Bahamas. And when we're not at a port, we're going to be in the classroom learning. We do a lot of private parties, networking. It's a ton of fun. We have about 20 faculty members this year, so you get a big 360 on a lot of different topics. But better, you have about 100 investors from all over the world, and these are people who are actively investing. And just talk about compressing time frames in terms of getting connected and getting perspectives in a week plus a day or so of pretty intense study and conversation, and a lot of fun. I mean, we have a lot of fun on those summits.
And for Kim and I have been on your cruise, and hopefully we'll be on next year's 2016 cruise. And you guys do have a lot of fun. But most importantly, you guys know what you're talking about. Your instructors are fantastic. But the most important thing, I think, is the people you meet. You meet like-minded people who are not doom and gloom people. They're progressive, they're moving, they're talking, they're willing to share what they know. And you guys do a fantastic job. And also your seminars are incredible. So anyway, I want to thank you for being part of the Rich Dad Predictions. To me, it's optimistic. You just pay attention to where the people are flowing to. Any comments, Kim?
No, I appreciate it. Appreciate the time, Russell, very much. And you know what else I love about you and Robert? You're out there practicing what you preach every single day, and we appreciate that and sharing your knowledge with us and with our audience. So I learn from you all the time, and I thank you for that.
Well, thank you. We obviously appreciate the work that you're doing in the world, and you'd be amazed how many people end up listening to the Real Estate Guys radio show that have come to us and said, what started their journey was they read that little purple book, Rich Dad Poor Dad, and then they went out in search of information and they find us. So thank you. I think it's fun working together to elevate the financial well-being of humanity.
Well, thank you,
Thanks,
Russell.
Russell.
Say hello to Robert Helms for us.
Yep.
Will do.
All the
Thank you.
best.
Thanks.
Thanks.
Bye.
Bye. So our next guest on Rich Dad's Predictions is Richard Duncan, and he's been our friend for years. I came across his book at Borders, which is now out of business. But I was walking past his desk piled with books, and it said The Dollar Crisis. And Richard is a graduate of Babson and Vanderbilt, great schools. He's an economist. He's worked for the IMF and the World Bank.
So we're talking about predictions, and part of our predictions is that we know we need to keep studying. We need to keep learning. And the way we actually met Richard was we were doing a group study where there was probably about 100 of us studying the book, The Dollar Crisis. And we contacted Richard and said, would you be available to call in and answer some questions? And he's very much an educator, very much a giver, as well as an incredible economist. So that's how we met. He actually called in, and we spent about an hour talking with him and asking. We had so many questions because it's not the easiest book to understand if you're not of that mindset. But it was a fabulous first introduction.
Yeah, but like Russell Gray was saying, that people moving out of this country, Richard Duncan has moved out of this country and now lives in Thailand. So that should tell you something about what he thinks of the world economy. So here's Richard Duncan.
Robert, Kim, hey, it's great to see you.
So Richard, why are you living in Thailand? You're an American. What are you doing out there? And what do you see coming in the future? And what predictions are you making today?
Well, I live in Bangkok. I've actually been living in Asia most of the last 30 years. I first came over to Asia when I was 24, back in 1984. I came over as a backpacker, and I spent a couple of months traveling around Thailand and Malaysia and Singapore then. That was between university and business school. And I realized that Asia was booming. And it's a very nice place to live. So I went back to business school in the US for a couple more years. And when I finished that, I moved to Hong Kong, and I found a job working for a stockbroking company, doing research on the listed companies in Hong Kong. And I've lived in Asia most of the time since then, moving around between Hong Kong and Singapore and Thailand. So altogether, I've lived in Thailand 13 years over 2 different times. My wife is Thai, and we live in Bangkok, and we also have a little house up in northern Thailand in Chiang Rai. It's just a very nice place to live. The people are nice, it's sunny, it's inexpensive. It's just a very nice place to live, so that's why I live here. We're on the verge now of 2016, and it should continue to be another interesting year. We have a very, very weak global economy. The global economy is more or less in recession now. Most recent data from Japan shows Japan's back in recession. Europe's very weak. And while the headlines on CNBC and the mainstream media make it seem that the U.S. economy is doing better, actually the U.S. economy is quite weak also. Manufacturing has gone back into recession, and it's going to be a very tricky year because the Fed is now talking about increasing interest rates. And if the Fed increases interest rates, that's going to make the dollar stronger. And a stronger dollar will be bad for U.S. exports and U.S. employment in the manufacturing sector. So also, it's not at all certain that the economy in the U.S. can withstand higher interest rates. If I can give you a little background on that, it's the way I view the world is credit growth is the thing that drives economic growth now. The world works very differently. The economy works very differently now than it did, say, 50 years ago and before that time when money was backed by gold. But once we stopped backing dollars with gold in 1968 and 1971, around that time, then the economy began to work in a very different way. And it began to be driven by credit expansion. So just for example, total credit in the United States first went through $1 trillion in 1964. And over the next 43 years, it expanded 50 times to $50 trillion. So from $1 trillion to $50 trillion in just 43 years. And that expansion of credit, it really created our world. It drove global economic growth, it drove U.S. economic growth. And as U.S. credit expanded, the United States was able to buy more and more from the rest of the world. The U.S. trade deficit blew out to extraordinary levels. It went from being in balance, the trade was more or less in balance up until 1980. And by 2006, the U.S. trade deficit had become $800 billion. And so the larger the U.S. trade deficit became, the larger the rest of the world's trade surplus became. So on the back of that trade surplus, Asia and much of the rest of the world was able to experience an extraordinary, really an unprecedented global economic boom on the back of the U.S. trade deficit, which the Americans were financing with more and more credit, more and more borrowing and debt. So if you look at total credit relative to the size of the U.S. economy, it went from about 150% of the GDP, 150 debt to GDP or debt to the size of the economy, was about 150% of GDP up until around 1980. But once the credit really started expanding rapidly, this ratio of debt to GDP expanded from 150% all the way up to 370% of GDP by 2007. But during that time, interest rates were coming down very sharply. So back in 1980, Paul Volcker had increased interest rates very sharply to kill the inflation of the 1970s. And banks were lending money at as much as 20% interest. But after 1980, the rate of interest came down and down and down and down. And now the federal funds rate, the rate the Fed charges the banks, is actually zero. It's been zero now for 7 years, 0% interest. So it was only possible for credit to grow that much so long as interest rates were coming lower and lower and lower. And now if the Fed begins to hike interest rates, it's going to be very difficult for this level of credit to be maintained. And if credit contracts, then the U.S. will go back into severe recession. So I think we're going to have a difficult year, both in terms of the GDP, the economic growth in the U.S. and globally. And at the same time, I think it's probably going to be a hard year for the stock market as well. As long as, so we came very close to collapsing into a new Great Depression in 2008 when this credit started to contract. But the government prevented that by running trillion-dollar budget deficits year after year. And on top of that, the Fed, the central bank, had 3 rounds of quantitative easing, basically printing money from thin air and injecting this new money into the financial markets. And as long as they printed money and injected it into the financial markets, well, not surprisingly, the stock market went up. So just in the 3rd round of quantitative easing, when it was at its peak in 2013, that year the Fed printed more than $1 trillion. And that year, the stock market went up 30%. Well, the next year, they printed less, only $500 billion. And that year, 2014, the stock market went up 11%. But in 2015, they had stopped quantitative easing, and the stock market hasn't gone up at all. And now they are discussing doing more or less the opposite of quantitative easing, increasing interest rates. If they increase interest rates, it's quite likely that the stock market will have a significant correction. So I think it's going to be a difficult year for the U.S. economy and for the U.S. markets. And that's going to make an already difficult situation for the global economy considerably worse.
Richard, do you really think the U.S. government is going to do another quantitative easing? They're going to go to QE4? You really think that?
Well, Kim, I mean, that's a very important question. The Fed is saying that they are going to begin increasing interest rates in December. And they are saying it again and again. So if they don't increase interest rates in December, it is going to come as a real shock to the market. So at this point, it's almost certain that they will begin increasing the federal funds rate in December. Now, we'll have to see what the consequences of that will be. I saw a really funny cartoon that I really think sums up the situation very exactly. It said, this is the way the Fed thinks. If the S&P 500 index is above 2,100, which is more or less right where it is now, then the Fed will hike interest rates. But if the S&P index is between 1,800 and 2,100, then the Fed's just going to talk incessantly. And if the stock market is below 1,800, then the Fed will launch QE4. And I think that's exactly right. I mean, that really sums it up. What we all have to understand now is that the government is directing the economy. And the way they're directing it is they are printing money and pushing up asset prices, pushing up the stock market. It's extraordinary. From the bottom of the crisis in 2009, because of quantitative easing, the Fed has pushed up household sector net worth. That means how much average Americans own, all the Americans own in total. Household net worth has increased by more than $30 trillion. It's now $86 trillion, well above the level it was in 2008 at the previous peak. So by printing money and pushing up asset prices, this has created what they call a wealth effect. The Americans with stocks and property feel richer, so they go out and spend more. And they tip the bartenders more. And so it drives the economy. That's how they're driving the economy. And that's crucial because that is the main driver of the growth right now. The credit is not growing rapidly enough to drive the economy the way that it did in the past. And so the economy is fundamentally weak. And also, globalization is pushing down wages in the U.S. Before the 1980s, if General Motors wanted to build an automobile, they had to pay someone $200 a day in Michigan. Well, now they can pay someone $10 a day in China. So that's pushing down wages in America. The U.S. is deindustrializing. Wages haven't increased now for decades. And so there's no fundamental source of growth in the U.S. economy. And that has pushed the Fed into driving the economy through quantitative easing and pushing up asset prices. So the way I look at the economy is, I think, okay, what will the government do next to drive the economy? What do they have to do to make the economy grow? And I think what they have to do at this point is to make sure that the stock market keeps going up. So for a number of years now, I have my target for the end of this year on the S&P index was 2,100. I expected some significant corrections in between as we went along. But my thinking was that the stock market needed to appreciate by about 10% a year in order for the government to be able to make the economy grow. And so whatever it takes to make the stock market go up that much is what they will do. So I think that one way or the other, they're going to have to keep pushing up the stock market. So they would like to increase interest rates because they can't say that this economic crisis is over as long as the federal funds rate is 0%. obviously that's something completely unnatural. So they would like to return to a normal situation where the federal funds rate is more like 3.5% or even 4%. And they're going to try to normalize interest rates. But I'm afraid what they're going to find is that when they increase interest rates, then the stock market is going to have a significant correction. And at that point, they will probably have to backtrack. And if they have increased rates, they'll have to cut them again. And if the stock market doesn't respond to that, then they will have to launch QE4. So if necessary, they will launch QE4 to make sure that the stock market keeps going higher, and certainly to make sure that it doesn't crash too much below 1,800 on the S&P 500. But Kim, it's going to be very interesting to see what the global repercussions of this interest rate hike will be from the Fed. And here in Asia, we keep a very close eye on China, as everyone should, since it's now the second largest economy in the world. And the Chinese currency, the Chinese yuan, is tied pretty closely to the US dollar. And that means if the Fed hikes interest rates, higher interest rates will make the dollar appreciate against other currencies like the euro and the yen. And because the Chinese yuan is tied so closely to the dollar, the Chinese currency will also appreciate against the euro and the yen. And that's a very big problem for China. China's economy is now going into recession. They're really having quite an economic crisis there. Their growth model is in crisis, and their exports are already dropping year on year. China has been driven by export-led growth, but now their exports are no longer growing. Their exports are actually contracting. And so China really can't withstand an appreciation of its currency. So there's a very real risk, I would call it a danger, that if the Fed hikes U.S. interest rates, China will devalue its currency against the dollar. Now, there was a small devaluation of the Chinese currency in August, and this sent shockwaves around the world. It only devalued by about 2 or 3% against the dollar, but that was a big problem for the rest of the world because all of the other countries have to compete against China. And so if China devalues its currency by 3%, and China becomes 3% more competitive. And it also reduces China's ability to buy goods from the rest of the world by 3%. And so, in other words, it exports deflation. So if China were to devalue its currency by 5 or 10%, this would send a wave of deflation around the world. It would also mean that commodity prices, which have already been crashing because of weak demand from China, commodity prices have already fallen to a 16-year low now. Well, that would push them down even further. And that would mean that all of the commodity producing countries like Brazil and Malaysia and Australia and Russia, many of the emerging markets, all of their economies would suffer. And all of their currencies would probably also depreciate. Their companies would not have enough cash flow perhaps to repay the dollar debt that they've undertaken. And even the American corporations and the British corporations, the mining and metal companies, oil companies, their profits would all take a hit, and the stock markets would have a significant correction. So one thing to be concerned about is the Chinese response to a Fed rate hike. China may devalue if the Fed hikes, and that could be the next source of global instability in the markets.
So, Richard, I think this is probably the most difficult or the most important question I can ask you, and if you could explain it. You talked about how money is flowing, like it flowed out of the U.S. into the petrodollars, the Arab states, then it flowed to the South American countries and Mexico, which caused the peso crisis. Then it moved to Japan, and then the money flowed into Thailand, the seven dragons, Thailand, Singapore, and then it flowed into China. Now that China is going down and the money is flowing out of China and back to the U.S., this is the most important question. As the money flows out of China and back into the U.S., will that toss the United States into a bubble, or that money flowing in be a crash? It's probably the most important prediction I think you can make.
Okay, well, yes, so you're right. These money flows are extremely important. And in one of my books, I describe this process as it's like a loose cannon on the deck of a sailing ship. The ship tilts one way and the cannon rockets across and causes havoc on one side of the ship, and then the ship tilts the other way and the money floods in another direction and causes havoc in the other side of the ship. This is the way that the money's been flowing around the world now for the last 3 decades. And the main origin of this loose cannon money, as I call it, has really come out of the U.S. trade deficit. Now, up until around 1980, the U.S. trade was in balance. But starting in 1980, after the breakdown of the Bretton Woods system in the early 70s, the United States discovered that it could buy things from other countries, and it didn't have to pay with gold anymore. It could pay with dollars. And so it started buying a lot of things initially from Japan. And as the trade deficit with Japan became larger, then Japan's trade surplus became larger. And that meant more and more dollars went into Japan. And those dollars in the 70s and 80s eventually blew Japan into a giant bubble. And that bubble popped in 1990. And Japan's economy has been in crisis ever since. And the next round was the Asia crisis countries, Thailand, Malaysia, Indonesia, and Korea. And I was living here in Thailand then. That's where I learned how this works. And more recently, the U.S. trade deficit became so large by 2006. That year alone, it was $800 billion. So that threw off $800 billion into the global economy. And a lot of that went to China. China has such a large trade surplus with the United States now. Last year, it was $340 billion just last year alone. So this money has flowed into China, and it's blown China into a big bubble. And their bubble is now beginning to deflate. They don't know how to keep it inflated. So that's the real challenge facing China, that's having severe repercussions all around the world. But so what we've seen, though, since 2006, when the U.S. trade deficit peaked at $800 billion, once the U.S. went into crisis in 2008, the Americans couldn't afford to buy as much as they bought before. So the trade deficit went from an all-time high of $800 billion back to just $400 billion. So that was throwing off much less money in the global economy. And for that reason, that's why the whole world went into crisis in 2008 when the United States did. Now, so in a sense, this global recession that we're looking at currently is a result of the U.S. trade deficit not being large enough to pump enough dollars into the global economy to keep the global economy growing. So I wonder, perhaps one reason the Fed is so keen on increasing interest rates, despite the very weak U.S. economy, perhaps they want to make the U.S. dollar stronger. Because if they make the dollar stronger, that means the U.S. will be less export competitive. It will export less American goods, and it will buy more and more cheap foreign goods. And that will make the U.S. trade deficit grow again. And that will make more dollars flood into the global economy and help the global economy grow. So I think this may be part of the strategy. But as the odd thing about this whole arrangement is that when dollars flow overseas, and they are accumulated by the central banks of the trade surplus countries. The Fed is not the only central bank that's printing money. All of the trade surplus countries, their central banks print money also. They print their own money and they use it to accumulate the dollars coming into their country. When a lot of dollars flood into China, for example, China has a $340 billion a year trade surplus with the U.S. The Chinese exporters who bring those dollars into China, they would like to convert those dollars into the Chinese currency, the yuan. If they did that without government intervention, that conversion of so many dollars into yuan would push the yuan up to an extremely high level, and that would kill China's export growth, and their exports and their economy. So the Chinese central bank prints its own money from thin air, and it buys all of these dollars that come into China. And once it's accumulated these dollars, then it has to take these dollars and reinvest them into US dollar denominated assets. So that's the odd thing. The bigger the US trade deficit becomes, the more money comes flooding back into the United States. The balance of payments, in other words, it has to balance. Trade deficit equals the inflow of capital. And so if the U.S. trade deficit becomes larger, then yes, more money will come flooding back into the U.S., and it will tend to do things like push up bond prices and stock prices. Of course, all other things being equal.
What Richard Duncan is an expert is the flow of money throughout the world. And as you know, the flow of money is now flowing out of China and flowing back to the U.S. So this is going to have pure, fantastic opportunities as well as dangers ahead. So as I said in this book, Rich Dad's Prophecy, 2016 is a year. So now as the money is flowing out of China back into the U.S., is it a good time or bad time for us?